In this video, we will demonstrate how to calculate the weighted average cost of capital using Apple. The weighted average cost of capital is a very important component of valuation calculations, as it is the blended rate that the company uses when raising capital. To access, we will click on the Research menu from the dashboard, Valuation, and Cost of Capital. We can free up screen space by clicking on the triple and double arrows. The weighted average cost of capital is divided into 5 tabs, and we will go through each in sequence. We will enter AAPL for Apple, and we're comparing it to its index, the NASDAQ. We're using a 60-month time period to the last closing month, and using the close price for the company. From this, we can calculate the beta. The beta is the expression of how much the company moves compared to its index. So in this case, a beta of 1.36 implies that if the index moves up 1, Apple will move up 1.36. Conversely, if the index moves down 1, Apple will move down 1.36. We also show the correlation coefficient for this calculation. The cost of equity is the cost that the company endures to raise capital in the equity markets. We will use the beta that we've previously generated and a variety of rates to calculate 2 different results for equity: cost of equity using the build-up method and the capital asset pricing model. We have a risk-free rate, an equity risk premium, industry size, and company premiums all available. We can actually enter negative numbers even to do the calculations. The cost of debt is the borrowing cost on debt that the company endures as it's raising debt. This calculation is done directly from the financial data that's available. The cost of debt is the interest paid divided by the total debt, reduced by the tax benefit that arises from having the debt. If there are preferreds, we also include those in the calculation directly from the financial data and combine them into a weighted average cost of capital. So the equity value of the company, based on current market value, is assessed against the debt value of the company from the financial statements, or the book value, and preferred would also be in book value to give us a total value for the company. Cost of the equity from our previous calculation, cost of debt from our previous calculations, and preferred, if they were there from our previous calculations, are all here, blended over the percentage of each in the capital structure to give us a weighted average cost of capital for Apple, in this case of just under 9%. We can save this and use it at a later time.